Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with Sticky Trades. And before we get into the chart analysis, I'd just like to point out that I follow the 7-point trading checklist when setting price targets on the major markets. And if you're brand new, you have access to this by going to stickytrades.com. You could simply sign up for a free membership, no payment required at all, and then you could download the PDF and follow along with my weekly market reports. Now, if you want the real state of the economy, here we go. This is actual numbers that have come out over time and are moving into the future. One of the biggest ones that I see here, if you look at Dollar Tree is closing 1,000 stores. Just go over this list and you'll see Big Lots is closing in California and Colorado. Regal Cinemas are closing. People just aren't going to the movie theaters anymore. Burger King closing 400 stores. Foot Locker, 400 stores. Look at that. And you see Walgreens, which really surprised me, is closing 900 stores. So if you look at the real state of the economy, fact is it's being flushed down the toilet and no one wants to use the R word. What is the R word? Well, the trucking industry knows exactly what that is. There's a U.S. freight recession right now. One of our members, Gino, pointed this out to me, and I found this on Business Insider. And you can see this week, JB Hunt stock slid as much as 13% on Wednesday after they missed on earnings. So this is a leading indicator, folks. When the freight companies are suffering, they get very competitive so they can get the jobs away from their competitors. And what happens is their profit margins slip just to keep the trucks rolling. And with insurance costs going up, these trucking companies are hurting for sure. In addition to that, you can see that this came out today. Good old Nod on our team put this out to the VIPs this morning. Investors pull $143 billion from the fund market. And this is marking the largest weekly exodus since September of 2009. And so money is flowing out. Now, one of the things that I want to point out here with this chart is that at the beginning of the year, you could see that the Fed rate expectations were moving pretty much in line with the NASDAQ and vice versa. But what happened is after January, the hopes of rate cuts were dwindling. And what happened? The market kept going up. Now the market is starting to correct, and we're mere minutes away from the market's closing, and we'll get right into the charts here in a moment. Last week, I talked about bearish engulfing candles. You remember that? And I talked about the different types of bearish engulfing candles. One of the most severe that you could see as a bearish signal is when you have a big fat red candle like that engulfing more than just one green candle. And you see here in this one, the most bearish of the bearish engulfing candles are showing an engulfing of 3 green bodies. Now, right before I did this video, I pulled up actual charts. There we go, the markets are closed. I pulled up the actual charts of the monthly candle charts on the 4 major markets. Look at DIA, it's engulfing 2 of the previous green months. Look at IWM, again, it's engulfing 2 and even the red one, so it's engulfing all 3 of these. So what that means here is that in IWM, anyone who has bought IWM and is holding it currently, anyone over the last 3 months in the first quarter, every one of those people are now down with unrealized losses if they haven't sold the position. Look at the Qs. We have 2 engulfing of the green right there. We have SPY. Again, I've never seen this, folks. In my 40-year career, I've never seen all of the major markets with such significant bearish candles showing right there at the top. Now, if we look at the actual charts, starting with the diamonds, if you had a chance to watch my midweek report, I did say that I was expecting a bounce by Friday. DIA, we did get the bounce. We do have a pivot. We finally see a green candle after this long stretch of 8 red days in a row, and the oscillators are going higher. So for the diamonds next week, Monday and Tuesday, I think we could go a little bit higher. I'm not getting crazy on the upside, but I'm going up to 381.81. Then keep an eye on the volume, because if the volume drops after that, we could see another turn lower. I'm going to get to the moving averages in a minute to show you why I think we're going much lower in the near future. So again, the forecast for next week, Monday and Tuesday especially, 381.81 on the diamonds. If you look at IWM on the daily, we got a green candle right there, and the oscillators are pivoting higher. So with the Dow, I do believe IWM is going to rally. I'm going up to 195.64. Again, if you look back at the past, you could see these diagonal lines are all of my previous forecast lines, and you can see how often these targets hit. These charts are absolutely amazing with targets hitting, and I am very happy for our members, especially the option traders, because we are negative delta. If you're not an option trader, that means that we are positioned for the downside. Our members are going to make money as the puts that they own increase in value. And again, if you want to learn more about how to trade options, go to stickytrades.com, plug into our educational website. We have Sticky Trades University, where we could start you off with some of the most basic candle patterns and concepts in trading and move you up the ladder as you advance with your strategies. All right, so that's IWM. Again, that target is going to be to the upside at 195.64. Moving on to the Qs, which took an absolute beating today. This is one that might be a little bit different than the other major markets. I think that we could go a little bit lower on the Qs, just a little bit lower. Then I think we're going to see a drop in volume. And then I think you're going to see the CCI start to turn up, as well as the stochastics starting to turn up. After these oscillators move up, I think we're going to see a bounce in the Qs. Could be a significant bounce. We'll have to see. But let me give you it's a 5-part forecast, by the way. No one's ever going to do this. Downside target first is 412.68. Then the drop in volume. The drop in volume will trigger the CCI starting to move up. The stochastic will follow. And then I think we'll see upside on the Qs at 419.57. I cannot wait until next week to see what kind of results we get after a 5-part forecast. Again, no one in the world will ever do this, and this is what I teach people how to do, is set your targets according to what you're seeing in the technical signals using that 7-point trading checklist. If you like what you're hearing so far, make sure you hit that subscribe button. We'd love to have you. All right, SPY, look at this. We still have an increase in volume on the way down. I think we, just like the Qs, we could see a little bit lower, then the drop in volume, and then we'll have the CCI. Here's another 5-part forecast with the stochastic also pivoting up, and then ultimately SPY will start to go back up. This is a roll reversal gap fill now. So again, downside target of 492.21, the drop in volume, oscillators pivoting up, and then the upside target of 498.91 on SPY. Now let's look at the VIX before I get into the moving average crossovers. Look how high the VIX got. It stopped pretty close to this resistance area up here. You see that? This is all resistance. So I do think we could go a little bit higher on the VIX to start off on Monday. And then I think we're going to pull back on the VIX, which could result in the market rallying, especially the S&P. So I'm going to go to the close here. I think we're going to pull right back. This is a very minor pullback, but we'll have to wait to see what happens on Wednesday. I'm going downside on the VIX to $18.09. We'll have to see whether or not that former resistance here turns to support here. If it does that, then the VIX will most likely start moving up and the rest of the market will start to sell off. So again, it's a very slight downside target on the VIX, but it's still a target that will stay in place until at least Wednesday. Now I want to show you something right here. I'm going to go to the moving averages now. I hardly ever talk about this, but it's very important that we do. Looking at the S&P, you see the blue line right there is the 20-period moving average. The green line is the 50-day moving average. The red line is the 100-day moving average, and the gray line is the 200-day moving average. Look what happened the last time the 20-period moving average crossed the 50 right there. We had a little bit of a rally. Again, it's exactly what I'm expecting for next week. All right, we had a little bit of a rally, and then boom, it was lights out for the market for at least 3 months. That's what I said in the midweek report. I'm using this phrase, lights out. That means that the bulls are going to get pummeled, especially after that moving average crosses below the 50. This will cause sell programs to start to kick in. The algorithms are programmed to recognize moving averages as they cross. This is not a death cross, by the way. That would be the 50 crossing the 200. We're away from that happening. But right now, this is a shorter term moving average crossing a major moving average, which is the 50-day moving average. Look at what we saw in the Qs today. We have the official cross. There it is. It's right on top of it. And so when was the last time we saw that? That was back here in August. They had the little bit of a pop, and then again, the general markets right across the board sold off. If you look at the diamonds, this is really interesting because the cross has already happened 2 days into it now, and the last time that happened again was back here in late August, and then the big sell-off. So the last part of this presentation here involves the old saying, sell in May and go away. We don't have much time left in April. I think we will see some heavy selling coming into May. And keep your eye on the charts. Keep your eye on sticky trades. Thank you so much for subscribing and liking. And I love the comments. I love your comments. That really helps a lot of people because the questions that are being asked are most likely going to be on the minds of many others who just haven't typed in that question. So yeah, questions are good. Comments are good. Liking, subscribing, all that is good. I love putting these videos together for you. I hope you like them as well. Please like, share, and post them all over your social media pages. Have a great weekend. So long.